Good morning and welcome to the RICARDO PLC investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Graham Ritchie, CEO. Good morning, sir.
Thanks, Paul, and good morning to everybody, and welcome to the presentation of the half-year results for Ricardo. As always, in these types of presentations, I just draw your attention to the disclaimer page. So for the agenda today, I'll start with a summary of the overall performance of the group and the progress on our strategic transformation. Judith, the CFO, will take you through the key financial detail. And then I'll spend a bit more time going through updating on the strategic progress that we've made in the last 6 months before finishing with some closing remarks and obviously then open up for questions. So we're continuing to build a strong sales momentum in most of our business units, which has led to a record order book of 477 million at the half year. This is delivered through particularly strong sales in defence through our ABS program, a strong recovery in rail that we've been predicting for a while, and more proactive sales as a result, and continued structural growth in EE. We've previously signalled the complexity of energy transition will mean the order flow in A&I will be a little bit lumpy, and we've seen some delays in A&I in the first half that have impacted the operating profit margin at the group level. As I'll show later in the presentation, we've seen improving sales momentum in A&I in the second quarter, which has continued into Q3, and that gives confidence for a good recovery in the second half. Underlying cash from operations is up 25%, with strong working capital management leading to 130% cash conversion. We've also made good progress in accelerating our operating model transformation with the alignment of our functional teams. These actions contribute to a strong second half, and we therefore remain confident in delivering our full year consensus. This slide is just a quick reminder of the sequencing of our 5-year transformation to become a leading engineering consultancy in environmental and energy transition. We're only 18 months through that 5-year journey, and we believe that we've made good progress so far with 1 divestment, 3 acquisitions, some fairly significant restructuring in A&I, and the consolidation and alignment of our functional teams. As we're seeing in H1, it's not always going to be a straight line in terms of the performance for all elements of the business, but the actions we're taking position us for acceleration into 24-25 and deliver our 5-year plan. Our strategy is to shift to having 75% of our operating profit generated in environmental and energy transition solutions. These solutions will typically be higher growth, higher margin, and have lower capital intensity compared to our established mobility portfolio. We don't have historic environmental and energy transition data, but given that more than 90% of the established mobility portfolio are in the assembly and production businesses of performance products and defence. If we exclude these to just show our consulting businesses, we have a pretty good proxy for the shift in environmental and energy transition solutions. For the total group orders graph shown in the middle of the page, the key message here is that we've made good progress in diversifying our business, with now only 6% of our business in passenger car automotive compared with 25% in 2019. And the A&I total orders being only 14% of the total group orders mix compared with 40% in 2019. These are areas that have typically been more volatile, impacting profitability over the last few years. And therefore, given the lower mix now, we have greater confidence of profit consistency going forward. Within the consulting orders graph, the proxy for environmental and energy transition solutions, the key message here is that 74% of our orders are in EE and rail compared with just 38% 5 years ago, and only 26% in A&I compared with 62% 5 years ago. As Judith will show shortly, EE and rail are the areas that are showing strong growth in revenue and margin, therefore giving confidence in the longer term growth and margin outlook for the group. We're therefore delivering on our strategy to become a diversified engineering consultancy in environmental and energy transition solutions. I'll now hand over to Judith to take you through the financial performance.
Thanks, Graham. Good morning, everybody. I'm now going to take you through the results for the first 6 months. As you've heard from Graham, it's been a period where we've seen a record order book and strong performance in our EE, rail and defence businesses, but where we've seen some delayed orders in our A&I business impacting overall group performance. Because of the strong order books and also actions we've taken to accelerate our operating model transformation, we remain confident around delivering our full year market consensus, but we'll see more of our profit weighted to the second half of the year. So whilst we have seen delayed orders in the A&I business, we've continued to see strong growth in order intake and revenue across the group and good cash performance. This is our usual KPI chart, and it shows the performance of the underlying continuing business on a constant currency basis. You'll see for the first half, our order intake's up 10% to 314 million, and revenue's up 9% to 224 million. Our order intake's exceeding our revenue, so our order books are growing. But because of those delayed orders in our A&I business and also some change in mix within our performance products business, we've seen our operating margin down 40 basis points to 5.4%. Because of strong order books and improved orders in the second quarter, and also the actions we've taken to accelerate our operating model transformation, which is going to improve profitability in the second half, we remain confident around increasing profit performance in the H2. Because of increased interest rates and hence an increase in our interest costs, we've seen profit before tax reduced by 15% to 7.9 million, and that gives EPS down 13% at 9.2p. We've had good cash performance in the first 6 months. Our cash conversion at 130% up on last year and ahead of our 90% target. That's giving net debt up just 1 million to 63 million and a leverage figure of 1.5 times. We've got a target leverage of 1.25 times, so that's a little above our target. But because of the improved profitability in the second half and ongoing focus on cash performance, we remain confident that that will come back down towards our target level. And then because of those strong order books, because of the actions we've taken to improve profitability, we're announcing an interim dividend of 3.8p a share. That's up 13% on last year. We're planning to maintain our full year total dividend in line with market consensus, and that's in line with our dividend policy of maintaining cover of 2.5 to 3 times. So looking now at the overall group performance, so as I said, our revenue's up 9%, gross profit though is up only 4%, and we've seen a little bit of erosion in our gross profit margin. That's partly those reduced orders in the A&I business, which has impacted utilisation there, but also that change in mix within our PP business. I'm expecting improvements in the second half. Our orders are already improving within the A&I business, and we've also taken action there to reduce our fixed cost base and improve profitability. And we're seeing a change in mix within our PP business. Our indirect costs remain absolutely under control and are reducing as a percentage of revenue. Because of the actions we've taken around our operating model and the centralisation of our enabling functions, I expect to see further reductions in those indirect costs going forwards. That gives operating profit flat on last year at 12 million. As I've said, we've seen an increase in our net financing costs up 1.4 million. That's predominantly due to increased interest rates, contributing to over 1 million of that increase. We've seen our rates increase from an average of just under 4% to just under 7%. But in addition, we did see our debt increase in the second half of last year as we invested in acquisitions. That gives profit before tax down 15% at 7.9 million. Our tax rate's running at just under 27%. I do think we'll see that continue to trend towards 30% as we see the full impact of increased tax rates in the UK, but also as we see increased profit in overseas jurisdictions with higher tax rates. And that gives profit for the period down 13% at 5.8 million. Looking now at the performance of our individual business units, first of all, our environmental and energy transition portfolio. The performance here has been impacted by the delayed orders within our A&I business, but we continue to see good growth and margin accretion in our energy and environment and rail businesses. In EE, orders are up, our revenue's grown by 35%. We are accelerating our growth there through acquisitions, and we made 2 successful acquisitions last year, which are both performing well. If you strip those out, our underlying organic growth is 18% in revenue. And we're seeing strong demand across our policy, strategy and economics areas, and also within air quality and environment. We've seen some margin accretion, so our margin's now over 17%, and that means our profit's grown by 40%, of which around 13% is organic growth. In our rail business, we entered the year with a really good order book and a strong pipeline. And as a result, we've seen orders up 23% and revenues grown by 10%. We're seeing strong growth in revenue in Australia and Asia on the back of recent project wins. And we're seeing growing opportunities within the US and Canada. With that increase in revenue, we get some operational leverage, so our margins are up at nearly 11% now, and that's meant profits grown by 17%. As we've said previously, our emerging A&I business operates across diversified markets of automotive, of aerospace, of marine, and also heavy-duty vehicles. And we're seeing new entrants into those markets and also existing clients having changing needs. So as a result, we're seeing some volatility in our order intake in the short term, but we remain confident around the long-term growth potential here. As a result of delayed orders in the first 6 months, our order intake's down and our revenue's down, and we've generated a loss of 1.5 million. But we've taken action in that business. We've really focused the business on our key growth solutions and our key core markets. And as a result, our order intake improved in the second quarter compared to the first. We've also taken actions to reduce our fixed cost base here. So reduce the fixed costs and increase our flexible resources. That's going to improve profitability in the second half, but also going to mean we're more able to manage order volatility going forwards. So I expect a profit in the second half as a result of the improved orders and the actions we've taken on costs. Looking now at our established mobility portfolio, we've seen a strong performance here with growth in orders, revenue, profit and margin accretion. And that's really been underpinned by the performance in our defence business. In defence, revenue's up nearly 50%, profits doubled and our margins are now over 19%. That's been driven by a programme we've got for the assembly of ABS kit for the DoD, which has been performing strongly and volumes are increasing there. Within our performance products business, last year we had order intake of 40 million on 2 key new transmission programmes. If you strip those out, our underlying order intake's up 13%. But we saw flat revenue in the first half as we expected because we've seen reduced volumes on our McLaren contract, which represents about 50% of this business. McLaren have had some issues around quality on those engines, and so we've been reducing our volumes there. We are starting to see volumes pick up in the second half though. Profit was down and our margin was down partly because of the reduced volumes on McLaren, but also because of a change in mix within the transmission business. As we look forward to the second half, as I said, we'll see improved volumes on McLaren, and also we'll see a change in mix in the transmission business as we see ramp up on a new programme and delivery starting to ramp up and go out the door. And then finally, in our established A&I business, again, we've been impacted by delayed orders, but we remain confident around the demand for our services in marine, in defence and in heavy-duty vehicles. Again, here we've seen orders increase in the second quarter compared to the first. And with the actions we've taken generally to reduce our cost base in the total A&I business, we expect to see a profit in the second half. We've also incurred some specific adjusting items, so 10 million in the first 6 months, predominantly around the amortisation of acquired intangibles and also the recognition of earn-outs on the acquisitions we made in the second half of last year, which are due for payment in the second half of this year. As I look forward though, because of the actions we've taken to accelerate our operating model transformation, we will be incurring further reorganisation costs in the second half of this year of around 7 million. So that's where we've been centralising and consolidating our enabling functions, and reducing that fixed cost base within the A&I business. The centralisation of those enabling functions is going to improve profitability in H2 and increase profit by around 4 million. And that's an annualised improvement of around 10 million. We've seen strong cash performance in the first 6 months. Our cash conversion at 130% is above our target 90% and up on last year. We've seen working capital reduced by 5.8 million. That's partly because we collected some delayed receipts from the back end of last year, but also because of an increased focus on working capital management. I'm really pleased with the progress we've made in the first 6 months, but there is still more to do. Within our PP and defence businesses, as we're seeing programs ramp up now, we really need to focus on our inventory levels and managing those at a sensible level. And within our consulting business, we need to focus on getting invoicing out the door, making sure we get invoices out on a timely basis, but also making sure we've got the correct contractual terms with our clients for regular invoicing. Overall, we've seen a cash inflow before acquisitions and restructuring of 2.5 million. That's up 6 million on last year, and broadly funds the acquisition and restructuring costs in the first 6 months, meaning net debt increased by just 1.2 million to 63.3. That gives leverage of 1.5 times, so that's a bit above our target of 1.25 times, but still well within our bank covenant limits. As we see improved profitability in the second half, and also as we manage our debt at similar levels to December, I expect to see that leverage reduce. We've also got good facility on our borrowing, so we've got an RCF facility of which 46 million was undrawn at the end of December, and we had just over 40 million of cash within the business. And finally, turning now just to our order book. So we've got a record order book at 477 million. Of that, around 215 million is deliverable in the next 6 months. That's up over 30 million on this time last year. Encouragingly, we're seeing growth in order book in just about all of our business units. The one exception is the A&I businesses, but in both of those emerging and established businesses, we've seen the order book deliverable in the next 6 months increase compared to the position at the end of June. So we remain confident around delivery of our second half revenue. And so to conclude, as I said, record order book, 477 million, and we've got good pipeline visibility. So that's giving us confidence around delivering our second half revenue. With the actions we've taken to accelerate our operating model, that's going to drive improved profit performance in the second half, and combined with that confidence on revenue, means we're confident around achieving market consensus for the full year. We've seen good cash performance in the first half, and we expect the costs in the second half on restructuring to be covered by that continued strong cash performance, so debt broadly in line with the December level. Leverage is going to return back towards our 1.25 times target as we continue to focus on cash management and see improved profitability. And overall, we remain focused on delivering organic growth across all of our business units. And with that, I'm going to hand back to Graham, who's going to take you through the journey we've made on our strategic progress, but also give you a feel for where that organic growth is coming from.
Great, thanks, Judith. So this next slide is just a quick reminder of the key building blocks of how we're delivering on our 5-year strategy, with the clear growth levers and enabling levers that we're focused on. This year, we're focused on the A&I recovery as a key item, and I'll share an update in a minute on the progress we've made. I am very much cautiously optimistic that we've returned the corner on A&I performance, and we can look forward to more consistent profitability as we go forward. We also continue to invest in our digital portfolio and market expansion, taking advantage of energy transition more broadly. We are also accelerating our operating model transformation to align our functional teams. As I've discussed before, we have historically been a very siloed business, and we see huge opportunity to deliver cost efficiency, but also accelerate our transformation with an aligned operating model. We're focused on creating a sustainable business model in A&I. As part of this, we've done a detailed review of our portfolio of solutions and the target markets into which we can support. As I shared at the start of the presentation, the passenger car market has seen a significant decline in the share of our total group orders, from 25% to just 6% in the last 5 years. We're therefore proactively targeting new customers in commercial vehicles, marine, and aerospace to expand beyond traditional automotive customers who are strategically insourcing their electrification capabilities. These other industries are all looking at ways to decarbonize their propulsion systems, but pure electrification is less likely to be the solution, certainly in the short term, given the performance, range, and energy infrastructure requirements. As a result, we are prioritizing our hybrid, sustainable fuels and hydrogen fuel cell solutions where we can leverage our combustion and integration expertise for these target markets. We've also made some changes to our operating model. I've appointed a new managing director for A&I and flattened the organization structure to create a clearer accountability for growth and delivery. As Judith showed, we have established greater resilience in H1 with nearly 10 million of lower costs in A&I compared to H1 last year. Further to the changes made in H2 22-23, we've looked at the flexible resourcing model at a growth solution and specific skills level, which means that that improves our ability to manage fluctuations in orders and deliver more consistent profitability. Finally, we have materially increased our sales discipline, establishing greater visibility and action planning our sales and marketing teams. As we will see in the next slide, this is starting to build good momentum on our order intake. So with the actions we have taken, we are seeing early signs of a change in direction in A&I. The graph shows the rolling 3-month orders trend over the last 2 years. On the left-hand side of the page, you'll see the downward trend in red through 2023. However, the green trend line shows the improving trend we had delivered in Q2 of this year, and I'm pleased to confirm that this has continued into Q3, and you'll see that the P7 and P8 numbers also continue that trend, and those are accurate numbers. You can also see the cost actions we've taken last year in March and this year with a further focus on flexible resourcing to reduce the revenue break-even point with a more flexible resourcing model. This has established a clear profit headroom between revenue and cost and therefore gives good confidence in a return to profitability in H2. We clearly need to maintain our sales momentum, but I'm cautiously optimistic we have the right team, strategy, and operating model to return to long-term sustainable profit delivery in A&I. This expected improvement in A&I performance, combined with the higher mix of higher growth and margin from EE and rail business units, underpins the overall group transformation. Within portfolio prioritization, we continue to invest in innovative solutions to accelerate our organic growth at the intersection of climate policy, environment, and mobility solutions. We're excited about the launch of our new digital platform in Q4 of this year, which will be the core for developing digital subscription revenues going forward. This digital platform will enable us to scale repeatable solutions across multiple industries and geographies, and we have a number of applications in development. The first application will be the conversion of one of the energy pricing models from the acquisition of E3M last year, which will have a phased launch across Europe from Q4 this year. We're also expanding our hydrogen testing capabilities, given increasing demand for ICE using sustainable fuels and also hydrogen fuel cell solutions. With our physical testing capacity already booked out for the next 12 months, we're developing digital twin solutions that enable accelerated product development. Within market expansion, our focus on energy transition is supported by large target markets that are also expected to see robust annualized growth rates. The global market for environment, water, and clean energy is estimated to be over 30 billion in 2027 and growing at more than 7% CAGR. Given our relative size, we believe we can deliver double-digit revenue growth in these business units. And as shared by Judith, we are actually delivering well ahead of that at the moment. Our confidence is underpinned by having leading expertise and track records of delivery in industries and geographies that are most advanced in some of these areas and can be further expanded into new geographies. An example of this is providing water management advisory services to NEOM in the Middle East, leveraging our team's expertise from Australia. Another example
Ladies and gentlemen, do bear me 1 second. I think we have just lost Graham's connection there. I'm just going to turn over to the other microphone. Bear with me 1 second. Just open the other microphone there for you, Judith. If you could carry on from where you were, Graham. So we've just lost your connection there.
So the global mobility consulting market is expected to be 9.2 billion in 2027, growing at 5.7% CAGR. We believe we can achieve consistent high single-digit revenue growth, underpinned by increased regulation across all mobility industries, leading to new propulsion technologies being developed. An example is supporting the California high-speed rail network, our first major rail program in the US. As mentioned, we've also been working on a number of hydrogen applications across multiple mobility solutions, as you can see on the slide. One of the most significant is the work we are doing in A&I with the Sustainable Hydrogen Powered Shipping Consortium, or SHIPES, to design and develop hydrogen fuel cell propulsion technologies to power the next generation of zero-emissions passenger ships. RICARDO is leading the specification, design, build and test of a 375 kilowatt fuel cell module and the design of a 40-foot containerized multi-megawatt power plant that combines the outputs of several fuel cell modules. The containerized solution is intended to be installed on board passenger ships. This is part of a wider strategy across the group to provide end-to-end environmental and mobility solutions to support the marine industry, combining our policy, environment, and mobility solutions. This short video gives a bit of color on that. So as Judith mentioned, we've accelerated the consolidation of our functional teams to support our One RICARDO delivery model. As we've just seen in the video, we are increasingly cross-selling services into marine and all our target industries. The actions taken deliver some cost benefit that helps underpin our full-year underlying profit guidance and will support our ambition to deliver mid-teens operating margin as part of our 5-year ambition. In addition, though, the actions are already accelerating improvements in operational efficiency and customer experience to support our growth ambition. A great example of this is creating one global sales enablement team with a consistent bidding process to improve customer delivery and ensure technical excellence in all our proposals. The team are also establishing standard sales performance reporting, including pipeline management and focus on the key opportunities to continue to build sales momentum across the business. So overall, we're making significant progress in delivering our 5-year strategic plans, and I look forward to sharing more progress in the second half. So to wrap up, in summary, we're accelerating our transformation to continue to deliver in the short term and achieve our ambition in the long term. In the first half, we've seen strong sales momentum with our strongest ever order book. This, combined with changes we've made in A&I and the cost benefits from the consolidation of our functional teams, gives confidence in the delivery of our full-year consensus performance. I'm also cautiously optimistic that the changes we've made in A&I provide visibility of a return to long-term sustainable profit growth in A&I. This, combined with the targeted digital and hydrogen investments in the attractive environmental and mobility markets, and the acceleration of One RICARDO operating model, continue to give me confidence in the delivery of our 5-year strategic objectives. That completes the presentation for today. Thank you for attention and happy to open up for questions.
Fantastic. Thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions just using that Q&A tab situated in the right-hand corner of the screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Thank you to all the investors who have submitted those. If I may, just start the Q&A session with the following question. This is from James. So thank you, James. How do you assess the integration of acquisitions into the broader business, and what impact on the financial performance do you expect to see? Can we expect more acquisitions to bolster the business? If so, in what areas?
So, look, good question, and look, certainly, obviously, something that we're very focused on to get value from the acquisitions we create. Look, I'm delighted to say that of the 3 acquisitions we've made so far, that all continue to perform well. As Judith shared in the cash flow and the exceptionals, actually we are paying out earnouts in this financial year as a result of a very good performance from the acquisition. So they continue to be very good additions to Ricardo. I think that's partly, obviously, the post-acquisition activity, but also more importantly, the alignment and the focus that we do in advance of acquisition, where we're very, very focused on where are the synergies in advance of purchase in terms of the growth. That's more from a portfolio perspective and market expansion from a geography and industry perspective, but also we're very, very focused on cultural alignment. So as acquisitions come into the team, we're very clear on how that cultural alignment is going to be successful as part of that integration. So those are the sort of key areas that we focus on both pre and post integration.
Fantastic. Thank you very much indeed. Next question from Rob. Thank you, Rob. Pleased to see you've confirmed full year consensus PBT. That seems a lot to do in H2. Can you please explain the bridge by components?
Yeah, good question. Our business is usually split sort of 40-60 in terms of H1 to H2 profitability. This year it's split more 30-70. If I look at the individual components, our EE and rail business actually are about a 40-60 split, and this year that's what they were last year. So it's just delivering what we've done in the past, and our defence business is going to be broadly 50-50 H1 to H2. So again, confident in there. I think there's 2 or 3 areas that are really going to drive that improvement in the second half. The first is in our performance products business, where we're seeing the increased volumes again on our McLaren programme, but also the ramp up on the new transmission programme. So that's definitely skewing more profit to the second half. The second area is within our A&I business, obviously a return to profit there compared to losses in both the emerging and established business in the first 6 months. And that's really coming through from the increased order intake in Q2, and also, as Graham showed you, the continued momentum there in period 7 and period 8, but also the actions we've taken around the cost base there. And then the final piece, we've accelerated that operating model transformation, something we'd planned to do, but probably had it planned more for the following year in FY25 rather than this year. So we've accelerated that forward, and that's going to give about 4 million of savings in the second half. So basically, EE, Rail, Defence continue their good performance to date, improved performance in PP from the change in mix and transmission, A&I recovery, and then the underpin from the cost savings on the enabling functions.
Yeah, and I think the key point on the A&I is that those orders are materially won. It's not with the success that we've had in P7 and P8, and again, good confidence in the visibility for March, that effectively gives us the visibility that we need.
Thank you very much. Next question we have here: how will the changes in recent government and opposition policies on net zero impact the business?
Look, so this is I'm guessing a question that is specific to the UK. Clearly with change of government here and potential pushback of some of the automotive policies, particularly, yes, we're aware that this is a concern. I guess particularly for automotive, as I referenced at the start of the discussion, we now only have 6% of our orders that are from passenger car market. So therefore, the shift from 2030 to 2035 in terms of the UK government pushback is not seen as a material focus for us. If anything, I think a Labour government is likely to be more supportive of the energy transition that we've got. But I guess the other key point here is that actually the global market and the scale of the market that we're focused on, with circa 30 billion, as I referenced in the slides, there is so much market opportunity internationally of opportunity here that we see very good opportunity globally to take our leading expertise into new geographies, but also new industries. So look, yes, the UK have some policies. The US, obviously, with change of election as well, may have an impact. But again, the geographic reach and industry reach that we look, there's still plenty of opportunity for us to continue to grow at the levels we've indicated.
Fantastic, thank you very much. Next question here. Can you discuss the order book and the sales process to win new business across the segments?
So look, this is one of the things that has really benefited from the consolidation of the functional teams. So as I mentioned in my few slides, one of the things that we've done is create a consolidated sales enablement team across the organisation for our consulting businesses, and what that is doing is creating much greater visibility of the pipeline, the coverage that we have in future months. And what that's then enabling is what we're focusing on our must-win deals, and how do we then prioritise the action planning, whether that be commercial flexibility, whether that be resourcing, whether that be commercial terms, whether that even be delivery of existing projects that will then lead to phase 2 of particular projects. So we're very, very focused on the things that are, and prioritization of the key deals that we want to be focusing on. We're also, as part of that team, creating a dedicated project management and delivery management focus, where again the technical specifications of projects are consolidated efficiently, and presentation of RICARDO as one RICARDO is again delivered consistently across the organisation. So that efficiency and focus enables us to join up the propositions across multiple growth solutions or services as we have across the business. So, for example, sustainability solutions being sold into our mobility customers, our water services being sold with our energy decarbonisation solutions. So by joining this up across the organisation, we've got much better joined up, customer focused proposition and delivery.
Thank you very much indeed. On the cruise ship marine opportunity, are these hydrogen power units mainly focused on auxiliary power, presumably 2 low kilowatt for main propulsion?
Yes, is the answer. That's the immediate main focus.
Thank you, Graham. How likely is it for you to divest of any of the activities of the established mobility portfolio to increase the pace of the transformation of the mix?
So look, these are areas that absolutely we will always look at in terms of potential optimizing of cash. We've said consistently, look, we're not going to be explicit on specific transactions of timing and when. But the focus on cash generation is a key part of our strategy to help us invest in the environmental and energy transition space. Defence, look, clearly the ABS program has accelerated and supporting that cash generation within the organisation. We're also very focused on developing new programs that can scale and create additional cash in addition to the ABS program. Similarly, as Judith mentioned, we've got some new programs in PP that, again, we continue to look to develop. So the strategy is really to generate cash, whether they're in the organization, and that's what we're continuing to do. But equally, we'll look at, are there potential ways to monetize if valuations and market conditions support that.
Thank you, Graham. What would mean for established AI future performance that the ICE transition to BEV takes longer than initially expected?
So look, this again is actually something that we are seeing a little bit more of. I think the going back to the previous question around with a perhaps a shift to the right of some policy in some jurisdictions. We think that the ICE and traditional combustion for longer is potentially something that we could benefit from. We will continue to obviously have relationships with all forms of mobility, and this sort of combustion for longer is certainly something that we're seeing a bit of interest in. But also, as I said, our real focus is around the market diversification and industry diversification, because the different customers, different tier ones, different applications will be going at different paces across this transition. But we do expect that as a theme, that we expect the combustion engine to go for longer, and also hybrid to go for longer, which is again why that's a particular focus for us in terms of how we operate.
Thank you, Graham. Question here, would a change of ownership at McLaren affect your contracts, i.e. change of control clause?
No, look, we've signed only in September last year an extension through to the start of the 2030s. That continues the engine assembly for the current models, and also takes them into their third generation of engine, which is likely to come online in 27, 28. So look, we expect to continue to be the engine assembly partner for McLaren, regardless of what happens in their funding. Look, actually, clearly there was some press at the weekend around, are they looking for additional partners for funding and development? Look, I think that can only be a good thing for us, because actually it continues the acceleration of and the support for the business. But equally, look, the Bahrain Fund have put quite a bit of money in to align resourcing and development over the coming few years. I think it would be highly unlikely for them to walk away now. And actually, look, I have quarterly updates with Michael Leiters, who's the CEO at McLaren, and again, the consolidation of their funding into the Bahrain Fund is again much or is very helpful in terms of their funding and continuity. So look, we're still confident that look, we've got a positive and strong relationship over the number of years.
Fantastic. Look, thank you both for answering those questions you can from investors, and of course the company can review all questions submitted and we'll publish those responses on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Graham, could I just ask you just for a few closing comments, please?
Thanks, Paul. So look, I mean, hopefully you've found the session informative. I mean, I think the key messages from my perspective is, look, there is a lot of change as we move from materially an automotive business a number of years ago to an energy transition, an environmental consulting business. There is a lot of change in terms of what we are doing, but we're making good progress both in the short term and the long term with the actions that we've taken to build the momentum in A&I, in sales, and creating the flexible resourcing model. We believe that we have turned around the A&I story and can look forward to stronger performance. The operating model changes that we've made again support us in terms of the underpinning of the financial year this year, and therefore, look, we're very confident in the full year market consensus. And Judith, went through the bridging items there. But I guess also increasingly important is, as a result of these actions and the investments that we're making in the longer term in digital and hydrogen, we're also increasingly confident that we're on the right path for our strategic journey as well. So, look, we continue to be confident and supportive of the actions that we're taking. So thank you for your time.
Fantastic. Thank you both for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order that management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of RICARDO PLC, we'd like to thank you for attending today's session. That concludes today's session, and good morning to you all.